Get ready, because what could be the biggest IPO of the year is right around the corner. We're talking about the medical supply giant Medline Industries, and it's finally going public. But here's the thing, with a massive price tag like this, is it a golden opportunity or is it an overhyped risk? Let's unpack it.
First things first, you just have to understand the sheer scale we're talking about here. At the top end, Medline could be valued at over $55 billion. Now, that's a number that makes absolutely everyone on Wall Street stop what they're doing and pay attention.
And that really brings us to the big question, doesn't it? With a valuation that high, is this deal a can't-miss blockbuster for investors? Or is it an overhyped bust just waiting to happen? All right, let's break down the facts and figure it out.
So, first up, let's get into the nuts and bolts of what is absolutely set to be a landmark deal.
Okay, mark your calendars. Here's the timeline you need to watch. On the evening of December 16th, that's when the final share price gets locked in. Then, bright and early the next morning, December 17th, the stock starts trading on the NASDAQ. The ticker? It's going to be MDLN. And then about a month later, you see that green shoe option expires? That's just Wall Street talk for the underwriter's option to sell even more shares if demand is through the roof.
So, what's really driving this IPO? Well, a huge part of the story is that this is a classic private equity exit. See, back in 2021, a whole group of PE firms, the big guys like Blackstone and Carlyle, they bought Medline for about $34 billion. Now, just a few years later, they're taking it public at a potential valuation of $55 billion. You do the math, that's a staggering 62% markup. This is their big payday.
But, to really get why it's valued so high, you've got to understand the company itself. This is a story that goes from a garage in Illinois all the way to becoming a global medical behemoth.
Yeah, this is not some hot new tech startup. Medline was founded way back in 1966, and for nearly 6 decades, it's grown into the world's largest privately held medical supplier. I mean, the scale is just immense. Tens of thousands of employees, a footprint in over 100 countries, and a massive catalog of everything from simple exam gloves to really complex surgical trays.
Now, what's Medline's secret sauce? What gives it that competitive moat? It's right here. Unlike a lot of its rivals, who are basically just distributors, Medline actually manufactures about 70% of its own products. This gives them incredible control over their own supply chain, which, as we all learned during the pandemic, is a massive, massive advantage.
All right, so we know the story, we know the secret sauce, but what about the deal itself? Let's follow the money and unpack the specific numbers behind this IPO. Here are the numbers you need to know. The company's putting 179 million shares up for grabs, and they're aiming for a price between $26 and $30 a share. If they hit the high end, that means they could raise over $5 billion. Just a huge influx of cash. And like we said, you'll find it trading on the NASDAQ under the ticker MDLN.
So, where's all that money going? Well, its main job is to strengthen the company's balance sheet. They're going to use the cash to pay down a pretty big chunk of the debt they took on from that 2021 buyout, bringing their total debt down from $18 billion to a much more manageable $13 billion.
Okay, so this brings us to the real dilemma for any potential investor. There are some really compelling arguments for jumping in, and some equally strong ones for staying away. So let's look at the bull versus the bear case.
Okay, on the bull side, the optimists, they love Medline's defensive mode. I mean, hospitals always need supplies, right? That makes it a pretty recession-resistant business. That supply chain edge we talked about, another huge plus. And there's still room to grow with new tech and in emerging markets. But the bears have some good points too. They're really worried about that PE exit premium. That 62% valuation jump makes them think the easy money has already been made, and the PE firms are cashing out at the top. They also point to things like trade tariffs, fierce competition, and of course the risk that comes with trying to execute as a brand new public company with everyone watching.
So, you've got strong arguments on both sides. How in the world can we predict what might happen when the stock actually starts trading? Well, let's look for some clues from the analysts and see how similar companies have done lately. The general feeling on Wall Street is what you'd call a cautious buy. Most analysts are setting price targets somewhere in the $35 to $40 range. That suggests there could be a 20 to 30% upside from the IPO price. But here's the key. They see this as a long-term, 3 to 5 year hold. This is not a stock you buy hoping for a quick flip. And if we look at other recent medtech IPOs, you can kind of see a potential pattern for Medline. Take a look at that day one pop column. Big jumps right out of the gate are pretty common. But then look at the long-term returns. They're more mixed.
Sure, Beta Bionics has soared, but others have delivered much more modest gains. This tells us that even if Medline has a great first day, long-term success is definitely not a guarantee.
You know, one of the best ways I've seen the whole Medline investment idea summed up is this quote right here. It's described as a boringly brilliant bet on unglamorous essentials. This isn't some flashy, exciting tech stock. It's a bet on the fundamental, absolutely non-negotiable stuff that keeps our entire healthcare system running day in and day out.
So as Medline gets ready for its big public debut, the real question isn't just about one company's stock price. It's about something bigger. When that opening bell rings, what is this IPO's performance going to tell us about investor appetite and about the entire future of investing in the essential, foundational parts of the healthcare industry? We are definitely going to be watching closely.